is the Investment Intelligence Podcast by Allianz Global Investors, sharing knowledge about all things investing.
Hi, everybody. I'm JP Vicente, Head of Institutional Marketing at Allianz GI in North America, and the host of the Investment Intelligence Podcast. Our guest today is David Newman, who's the Chief Investment Officer of our Global High Yield team based in London. And for this conversation, David and I focused on the impact of recent market events on companies' credit ratings. Specifically, we talked about how the current dislocations are leading to a growing number of fallen angels, or those companies that are losing their investment grade status and falling into the high yield spectrum. But we covered a lot, including how to distinguish between a fallen angel and a falling knife, the large spread differentials between fallen angels and comparably rated high yield bonds today, how that translates into an opportunity, and much more. Oh, and we also learned about David's musical preferences, so make sure you stick around for his cultural recommendation. And now, without any further ado, let's get right to it. Hi, David, and thank you so much for being here with us today. So before we get started, please tell us who you are and what you do here at Allianz Global Investors.
Hi, I'm David Newman, and I am the CIO of our Global High Yield strategies. I've been with the firm for 10 years.
Thank you very much. And today you're speaking with us, from London. Is that correct?
Yeah, that's right. Locked down London. It's beautiful here. It's working from home.
So now this is our first transatlantic podcast. So thanks, David, and welcome to the podcast. As we record this episode, and that's on May the 15th, 2020, global financial markets have been trying high and low to regain their footing after the massive dislocations experienced in the past 2 months. And that's particularly true in the fixed income space. We've seen significant mispricing there due to the uncertainty about the COVID-19 pandemic and a lot of forced selling on the part of many investors. But the interesting thing about these types of corrections, or let's call them special situations as we do, is that they also create opportunities, especially regarding investment grade companies facing credit downgrades during the cycle. So let me kick off this conversation, David, by getting your assessment of the fixed income market in general and of those so-called fallen angels in particular.
So I think what we're seeing now with COVID-19 is an acceleration of a credit cycle that was already in play. Already in the early parts of 2019, the market was worried about the amount of debt in certain investment grade companies and leverage in the system. But the rating agencies gave these companies a good year to grow into their capital structure, and the fear about fallen angels dissipated. What COVID-19 has done is meant that the rating agencies have to go and downgrade all of their growth strategies and forecasts. Mm-hmm. And because of that, it means that a lot of companies which were given leeway are no longer going to be given that leeway. So at the beginning of the year, the market was actually expecting investment grade companies that could be downgraded to non-investment grade of about the quantum of 900 billion. That's about 45% of the global high yield market. As of today, we've already seen 220 billion of fallen angels entering the high yield universe.
That's really interesting. That's almost 25%, almost a quarter of what you're expecting. So we can see a lot more of that.
Yeah, I mean, if you sort of take this theme a little bit wider, away from the companies which maybe stretch their capital structures and therefore aren't being given the leeway anymore, there are also certain sectors which are likely to see longer-term structural changes. So sectors such as the oil sector, the leisure sector, the retail sector, all of that is also being challenged. And we've seen a number of securities within those sectors being downgraded. On the other side, we've actually seen quite a lot of central bank support. And what they are doing is trying to provide liquidity for companies impacted by this slowdown. It's been very clear in the US on both Main Street and also on the primary and secondary credit buying facilities, but also in Europe as well. But it's very clear that this support is liquidity and not solvency.
So let me ask you about that, pick up on that liquidity issue. Can you talk to me a little bit about the current spread levels and where are the fallen angels, kind of falling, if you will, in that realm? Where are the spreads now? What are you looking at? What are you seeing in the market?
So if I just look at a simple index, such as one provided by Merrill Lynch, their fallen angel index has got a current spread of about 720 basis points. And that compares to a double B index right now of 560 basis points. And by definition, these fallen angels are also rated double B. So you're effectively getting about 25% more spread than similarly rated double B high yield bonds. And the major reason for this is the fact that the investment grade market is so much bigger than the high yield market. There are many names which have been downgraded or been talked about being downgraded, which may have 30, 40, 50 billion of debt. Within the high yield universe, a large issuer may have 10 billion of debt. So for high yield funds to go and absorb 20 or 30 or 40, that debt needs to be very attractively priced for the high yield guys to go and buy it. So the investment grade guys are trying to sell it. The high yield guys will buy it as long as they're happy with the credit profile, but they are going to take their pound of flesh and get it at a cheap price level.
That's interesting, David, especially that last part about the pound of flesh. So if we have a special situation like we have right now, and if there ever was one, let's drill a little bit deeper into that, because surely there will be companies that will be downgraded during this cycle, and they will stay downgraded, if you will. And then, so talk to me a little bit more about how you distinguish between a fallen angel and let's call it a falling knife.
Yeah, that's a huge point. To start off with, you asked about spreads, and right now single Bs trade 300 basis points wider than double Bs. So there's obviously a price impact if they continue to fall, let alone if they default. So that's the one thing you need to think about. And certainly if you looked at prior cycles, the rating agencies don't like to do multiple notch downgrades in one go, because it means that their rating methodology was incorrect. So while they've said we're going to be aggressive, and sometimes you get a 2-notch downgrade, you could certainly see many, many more notches of downgrades. So there were names which we played in our portfolios in the past, which were rated investment grade, went all the way down to triple C before going back to investment grade over a 3-year period. So obviously, as the market starts to absorb those rating changes, there can be material movements. So what we try to do is differentiate between typical businesses, which we think are a fallen angel, and those businesses which we think of as a fallen knife. And the most important thing is really the industry trends. Are these companies going through a cyclical downturn because there's been a shutdown, which has meant the GDP cycle is slower and lower? Or is there a structural downturn in their business? So what I mean by structural is that a business maybe won't exist at all anymore. Historically, when was the last time you used the yellow pages? For many of the listeners on the phone, how many of your kids actually know what a landline is? Right? So what businesses could be structurally impaired long-term by the virus rather than those which are short-term? I would suggest that people will continue to make phone calls. They will continue maybe to buy cars. They will probably buy food. They will buy alcohol. Will you go and decide to sit in a hotel in the Vegas Strip with another 4,000 people in the same room as you? Question mark. Will you fly as often as you did beforehand? Do you want to sit on a cruise liner with 5,000 other people who could be infected? So those sort of businesses potentially, not definitely, but potentially could see a longer term structural impact. We talked about the fact that we are sitting here at home today. So will commercial real estate be the same? So that's really, that industry trend is very, very important to try and think forward. What does this virus mean? And will I want to actually invest in that type of business? We then start to think about the financials of good businesses versus bad businesses. Good businesses typically have long-term liquidity profiles. That means they don't need much debt to get repaid in a short period of time. We know that for some companies, the Fed is buying debt with a maturity of up to 5 years. Of course, they've also put limits on the amount they're going to go and buy back. So if a company's got huge amounts of short-term debt, despite the Fed stepping in, it's not going to help. But if they have long, well-spaced out debt, it makes things a lot better. The other thing is access to lots of different types of funding bases. It's not just about bond markets, but do they have bank lines? Can they use the convertibles market? Can they raise equity? Can they raise money in the European markets as well as the US markets? So again, the more diversified your funding bases are, the more likely is that you can cobble together the financing you need to keep going.
So, David, it's really interesting to look at how companies are dealing with access to capital, liquidity, and how one has to be really selective in this market and looking at all these different things, because it's a really unprecedented or close to unprecedented situation. But what else are you looking at? Are you looking at cash flow? Are you looking at cost base? Are you worried about environmental issues when it comes down to differentiating between a fallen angel and a falling knife?
Yes, JP, I mean, that's a really important part of what we're trying to do. The companies which can survive a longer and lower growth environment are those that can reduce their cost bases. We all know it's very obvious when GDP goes down that for most industries, you will see lower revenues, lower EBITDA, earnings before interest, tax, depreciation, etc. But you need to think about what your fixed costs are. How much capital expenditure do you need to spend to keep your business going? Can you actually reduce your cost base by having less employees, by using less working capital, by using having less offices open? Can you actually pay less rent? So a good example of a flexible cost-based business would be a management consultancy. So it's just people. You can probably ask them to stop working, but the only cost base is actually your headcount. A real alternative on the other side of things would be a nuclear power reactor. So you're keeping it running whatever happens. So you've got all those costs, whether people want to pay for the electricity or not pay for the electricity. So you have that flexibility. So one is that industry trend. Do people still want your product? Two, if they do, how much is that going to get reduced by? And three, can you actually reduce your cost base so you can still make cash flow and repay your debt under those scenarios? And the final thing you came out with, which is just really interesting, is the environmental side, but also management side. So I do think that when there is scarce resource to allocate towards which fallen angels you want to invest in, it has to be those businesses which have got good environmental disclosures, limited litigation, and also management team that's pretty flexible and is drinking the Kool-Aid right now that things are different. Some management teams are still paying big dividends and even buying back shares, while others are looking to conserve their cash flows and make sure the businesses are ongoing. So I know which one I prefer to invest in.
Gotcha. Let me advance our conversation here by kind of sort of delving a little bit further into the role of central banks right now. So the Fed, for example, in the United States has announced that it plans to purchase corporate bonds if needed. That's a de facto way of providing a backstop to the market. So talk to me a little bit about the impact of such measures in light of this particular opportunity with fallen angels. Is it going to help? Is it going to create moral hazard? Will it make it more difficult to price the securities? How are you looking at this, David, please?
So the Fed and the ECB are both committed to keeping employment up and ensuring the companies do not suffer from actions that the government's instigated. So they are providing liquidity if needed. But what's most interesting is that the very statement that they are there has led to spread tightening and market demand. And that has actually resulted so far in lower than expected central bank purchases. We've all heard the old saying, don't fight the Fed. The Fed seems to be buying something. We want to buy it. And therefore, the Fed actually doesn't need to buy it because everyone is already buying it anyway. But remember that bank buying is at the front end of the curve up to 5 years. From my perspective, the most attractive fallen angel opportunities could actually be at the long end of the credit curve. So this is where the cash price of bonds are lower, which means that if we get it wrong when we invest, the amount it has to fall to a recovery rate and insolvency is less. And if we get it right, the spread duration means that the price upside is also higher. So what central banks are buying is maybe not the most attractive part of a fallen angel strategy for someone like ourselves.
Okay, no, that makes a lot of sense, and I think that the last point is really interesting. So it actually makes me think about another issue, which is part of the timing also when to do this. Of course, we know that timing in investing is everything, but not all timing is created equally. So it seems to me that timing is even more important when analyzing special situation opportunities. So how long do you think until spreads normalize? What's your view? I know you talked a little bit about it earlier in the podcast, but I would like to delve a little bit deeper into it.
Yeah, of course. So, we already said the reason why spreads look abnormally wide at the beginning is the fact that it takes time for the debt to get absorbed by a new buyer base. In fact, the FTSE run a fallen angel index, which provides greater weighting to the first 3 months, which gives you an interesting argument there that index believes that most of the value comes in the first 3 months. And certainly, if you go across the whole of the market, that is probably not a bad estimation. But a few things you need to think about. One, most of the spread widening actually happens ahead of the downgrade, and actually before the company gets junked, because every seller tries to beat the other sellers and becomes a herd mentality. Sometimes we've actually seen that bonds actually tighten when they are actually downgraded to non-investment grade. That's especially true for a small issue where they are regarded as safe. Now, safe, is a nuanced word, but typically non-cyclical with all those great fallen angel attributes and none of the fallen knife attributes.
That makes a lot of sense. How do you compare this current crisis with previous ones? Is it different this time? Is it not different? From your perspective as a bond portfolio manager.
It's very difficult because the timing and the outcome of the recovery from COVID depends on medical science, whether a vaccine is found quickly, whether antibody tests are working properly, and that will determine how quickly we come out of lockdown and the economies refire again. So there is a degree of uncertainty here for me with regard to this response. But I would say that given the scale of the disruption, the precedent we probably need to look at is the Great Financial Crisis. It's within my memory, it's probably the most apposite. Asian crisis, TMT, Russian crisis, commodity crises are much more specific than the GFC, which was very widespread. So there are differences. The GFC was a liquidity-driven crisis, driven by a lack of confidence and especially unknown leverage in the financial system. Today, there is less leverage in the system. And central banks, as discussed, have been very proactive in providing liquidity. So it's not a liquidity-driven crisis or a confidence in the financial system-driven crisis. It's a lack of the unknown about how long the crisis will actually continue and what will the impact be of the amount of debt which has been put into the system to support the economy, and whether businesses will continue to be the same going forward. So the economic impact will be tough, but as companies have termed out debt, unless they have a failing business model, default rates could be less than the GFC. The current thinking is that about 2/4 of output will be lost permanently and probably not replaced. But as long as this can be bridged by liquidity, which is where the banks are focusing, while growth will be slow thereafter, many companies will survive.
See, that's a very interesting point because I would like to get perhaps your assessment here in terms of let's say the amount of economic activity that will be truly lost. So I think there's a lot of uncertainty that pertains to whether or not there will be, let's call it, second waves of infections, et cetera. But are you feeling do you feel comfortable from the perspective that you have today in terms of the amount of aid that has been put into the system as a big enough or long enough, if you will, bridge to take companies from place A to place B? And what are the risks that you're seeing to that particular scenario right now?
I think that's almost an impossible question to answer. Because, again, how people react and how many people still have jobs in 3 quarters' time is very hard to predict today. So if we effectively have the bull case that a vaccine's found, antibody testing's there isn't a second wave, probably in the 3rd quarter, we will see people returning to work. Most people will still have their jobs. They'll start buying things. So companies will only have lost the sales from March of the 1st quarter and the 2nd quarter. That's a bull case. And certainly various markets seem to be pricing that in at the moment, I think, or at least hoping that's going to happen. And more of a bear case is that this just takes longer. So companies lose the 3rd quarter. Heaven forbid they might lose the 4th quarter. And that will have very different impacts on what they can do. So we talked about central banks bridging liquidity. These facilities so far are only going through to the end of September, and they are limited in amount. So there are certain businesses which will burn through that liquidity much more quickly than some others. Those typically be businesses with high fixed cost bases. We talked about those. That they will be burning through that liquidity much more quickly than those companies with flexible cost bases. So that will go and lead to a very different outcome. But I think it's worth sort of just thinking about what the credit markets were sort of thinking about here. Credit spreads typically try to predict what's going to happen in the future. What you're seeing is that the market today, in the high yield market, is pricing in around about 7.5% of default rates. In March, it was pricing around about 12% of default rates. So that's to my point that the market has felt a little bit more sanguine about where default rates are going to be. If you look at what various rating agencies have as a range of default rates for this year, it's 5 to 12%. And so the market's quite clearly just gone into the middle, slightly more optimistic. And what's driven that is their estimations of what they think GDP is going to be and how quickly we have a cure. Really, where the market goes from here in credit, but also I think in equities, because there's very high correlations, is going to be based on our knowns. And all our fingers are crossed that we start to see vaccines, testings, and a return to work as soon as possible, but without putting people's health at risk.
Given the uncertainties, right, that we have, that are plenty, that are many, what are the indicators that you're currently looking at, David, that would tell you if the boat is turning this way or that way, and more towards the bear case or more towards the bullish case?
What are we seeing with regard to infection cases? What are we seeing with the development of vaccines? What are we seeing with regard to antibody testing? We will also obviously focus on second wave infections. The second thing is you've actually got to go and follow the earnings of each of the companies which you're looking at. What are these companies telling you? I mean, they are at the coalface. They are actually seeing what's going on. I'm sitting in a house in London trying to analyze what's going on. I'm not managing a business who's trying to sell cars or watches or clothes or whatever. So how innovative have those companies been? There have been some companies which have been very, very innovative, but I do think it's very, very hard to make a solid recommendation here because it really is in the realms of the unknown.
The other thing that I wanted to sort of talk a little bit about is, we've talked, of course, about a lot of, we talked a lot about fallen angels. And it makes me wonder how investors should sort of think about it in the context of a portfolio allocation, because it's kind of a not a hybrid security, but it's a special situation type of security. So which bucket of the portfolio would fallen angels be deployed into?
You make a good point, because if you look at fallen angels and the behavior of a fallen angel index versus investment grade or high yield indexes in fixed income, looks very, very attractive longer term. If you even look at the performance of fallen angels for the point of a 12-month return for someone investing right in the depth of a recession like we are now, historically at least, you've seen that fallen angels actually provide better returns than equities as well. And that doesn't really surprise me, because if you think about how a capital structure works, equities is the first cushion, high yield debt is the second cushion, investment grade is the last cushion. So as valuations come down, equities gets hurt first, then high yield stroke fallen angels, and then investment grade. As the world starts to return, the first thing that gets fixed, investment grade is probably still solid. High yield gets fixed first, then equity gets fixed after that as the world gets better again. Fallen angels are generally less levered high yield companies. So they don't get hit maybe as much, at least the fallen angels, not the knives, as much as the whole of the high yield market. And they also, because they have less leverage, generally recover quicker as well. So some of our analysis shows that if you looked at a control group of fallen angel double Bs versus non-fallen angel double Bs, so companies which have never been investment grade, 3 years and 5 years out, those fallen angels are more likely to get upgraded than the control group. And they have no worse risks of being downgraded or defaulting as well. So that's where fallen angels behave very well. They should certainly be part of the high yield strategy. But I also think they could be seen as a separate, unbenchmarked total return strategy for those who don't have high yield exposure. Otherwise, you may have a risk of doubling up. I did mention that at this stage of the cycle, equity investors who are concerned that the S&P is nearly back at pre-virus levels could start to think about diversifying part of their risk short-term and tactically into fallen angels as well. And just the last thing we've seen from a couple of people is that we've had some people thinking we're just interested in playing that 3-month price dislocation strategy, buying ahead of the downgrade and selling when spreads normalize. So it's a different way of playing with fallen angels, a shorter term strategy, but there are many, many ways fallen angels can fit into a portfolio.
So let me just then ask you another question, which is related to this. So let's assume that once one thinks about investing or considering fallen angels, how do they unwind these types of investments as the fallen angels, potentially turn into saints again?
Yeah, as capital structures improve, the first stage, as I said, is that the higher quality names should, as long as they're not fallen knives, go back to investment grade. And the next stage of this repair cycle is very much more vanilla, lower rated, high yield. So the single Bs, the triple Cs, the more cyclical type of names, which are not names you typically want to invest in going into a recession, but there are names you want to invest in going out of a recession. So one way you start to look at it is to just roll your fallen angel exposure into a high yield type of portfolio. And as the world continues to get better, that at some stage in the future could start to move into equities.
Thank you, David. So we are we have created, I would say, since this is our third episode, a tradition here to end the podcast with a cultural recommendation. So this has been a very interesting conversation about bonds. I would like to shift gears a little bit and talk a little bit about a book you're reading or a movie you've seen or some music that you're listening to. So anything that's been stimulating to you from either an intellectual or an entertainment perspective. What are you doing during the quarantine that is not looking at bonds?
Well, certainly not intellectual, because the bonds are taking up most of my little brain cells. So I've actually used the lockdown to run through and listen online to all the classic albums that one is meant to have listened to. So going all the way back from Elvis Presley through James Brown, through the Beatles, Moody Blues, all the way up to current stuff coming out of Kanye or Drake. Now, my conclusion, I think, still is that the UK punk rock and alternative explosion of the late 70s, 80s still blows the rest away. I actually listened to The Crack by the Ruts. If Malcolm Owen hadn't have died, they probably would have been bigger than The Clash. It's a classic. I actually saw the Ruts DC in concert once, and they were one of the best live bands I've ever seen, along with The Damned. So I would certainly think about using this opportunity to listen to stuff you never listened to before. You'll probably hate most of it and still love what you like, but it's always good to test your own conclusions.
That's fantastic. And London Calling, by the way, by The Clash is still like one of my favorite rock and roll like albums of all time. I got to say, I know you just mentioned that the Crack could have been bigger than The Clash, but The Clash is high up there in the pantheon, isn't it?
Oh, absolutely. I saw them once when I was 17, and it was amazing.
That's amazing. That's great. Thank you. Thank you very much. Well, I have a cultural recommendation as well, and I'm going to follow, I guess, David's footsteps here and go with a music recommendation as well. And mine is Jason Isbell's latest album. The album's called Reunions. The album actually dropped today, the very day that we're recording this podcast, although some of the songs had been released in anticipation, of the launch. So, but I particularly like two songs there. One is Only Children, and the other one is St. Pete's Autograph. Those are amazing songs, very, very deep kind of, songs really. And, but the whole album is really great. So, and Isbell, in my view anyways, is among the best songwriters alive today. So that's all the time that we have today, folks, on the podcast. I thank you, David, so much for being with us today. And thank you all so very much for listening. So stay safe, everyone.
Stay safe. Thank you very much.
This podcast was recorded on May 15, 2020.
Investing involves risk. The value of an investment and the income from it will fluctuate, and investors may not get back the principal invested. Past performance is not indicative of future performance. This is a marketing communication. It is for informational purposes only. The information contained in this recording does not constitute investment advice or a recommendation to buy, sell, or hold any security, and shall not be deemed an offer to sell or a solicitation of an offer to buy any security. The views and opinions expressed herein, which are subject to change without notice, are those of the issuer or its affiliated companies at the time of publication. Certain data referenced are derived from various sources believed to be reliable, but the accuracy or completeness of the data is not guaranteed, and no liability is assumed for any direct or consequential losses arising from their use. The duplication, publication, extraction, or transmission of the contents, irrespective of the form, is not permitted. This recording has not been reviewed by any regulatory authorities. In mainland China, it is used only as supporting material to the offshore investment products offered by commercial banks under the Qualified Domestic Institutional Investor Scheme pursuant to applicable rules and regulations. This recording is being distributed by Allianz Global Investors and its affiliates. For a complete list of affiliated entities, please visit allianzgi.com.